KOSPI clears 9,000 for the first time, up 2.25%. I mean, it sounds historic, right? Unprecedented even. Well, welcome to this explainer, where we're going to unpack why this massive headline number is actually hiding a pretty severe structural shift underneath. We are tracking a major market bifurcation right now, and the numbers absolutely demand your attention. All right, let's look at the top line facts first. The index closed up 2.25% for the session, hitting a historic 9,063.84. It is literally the very first close above 9,000 in the entire history of the exchange. At a glance, the momentum looks completely unstoppable. That plus 2.25% print, it's dominating financial networks worldwide right now. It signals massive buying pressure, overwhelming liquidity, and a breakout rally that has pretty much everyone celebrating. The index is absolutely surging. But here is the rug pull. 83.6%. That is the exact percentage of constituent stocks that actually fell today. Yep, you heard that right. Over 8 out of 10 stocks lost value, just bleeding out on the exact same day the index made history. So, the absolutely crucial question here is this. If the overall index just surged to a record high, why did your portfolio likely turn red today? How on earth are mathematical index gains completely masking such a brutal reality for everyday investors? Well, to solve this mystery, we've got to look at the macro catalyst. Let's stack the timeline. On June 17th, the Fed holds rates, but their projections show rates staying higher for much longer. The median dot plot actually shifts higher to 3.80%. And then, the very next day, the Korean 3-year yield spikes. Basically, short-term borrowing costs are moving up and fast. Now, this rate bump triggers what finance nerds like to call DCF asset compression. In plain English, high short-term rates mathematically crush the present value of companies that rely heavily on distant future earnings. It happens fast, and it instantly punishes software and platform stocks that trade on those long-term growth promises. And this immediate fallout hits hard. Just look at the platform dump. Naver drops over 3%, Kakao declines around 3% too. They absorbed that discount rate increase entirely, perfectly mirroring the software hits we saw in US tech names like Meta and Microsoft just a few hours prior. But here's the thing, that capital didn't just vanish, it rotated. AI hardware gets a free pass in this kind of environment. Large tech companies are fully committed to multi-year AI infrastructure spending programs. These massive capital expenditures, they completely ignore minor rate bumps. So, AI hardware is functionally immune right now. Let's move to the intraday numbers and see how this builds. Samsung Electronics rockets up 4.62%. SK Hynix advances a massive 6.51%. These specific hardware gains are so incredibly large that they're pulling the entire market capitalization upward entirely on their own. The fundamental validation behind this rally is actually really fascinating. SK Hynix didn't just move on pure hype. They initiated sample deliveries of their new HBM4E memory to major customers. We're talking about massive leaps in speed, a 20% power efficiency improvement, and just incredible capacity. The hardware is getting significantly faster and smarter. When you step back and look at the market heat map, the proof of this extreme sector rotation is undeniable. It's a literal sea of red bleeding out across the broad market, contrasted against ultra-concentrated blocks of AI hardware green. The market has completely split in two. We also have a secondary driver throwing gasoline on this hardware fire, and that's supply chain shortages. Reports cite severe shortages in AI server MLCC components. These are tiny but absolutely crucial electronic parts. Because of this, Japan's Murata surged 8.10%, while Samsung Electromechanics matched it, jumping over 8% after announcing mass production of their own high-capacity components. Now, this massive divergence isn't just happening in tech. Look at energy. WTI crude fell following a Middle East ceasefire memo which pretty much wiped out the relative cost advantage of renewables. Simultaneously, the government approved new nuclear sites for the first time in 15 years. So nuclear expands, while renewable and hydrogen names absolutely plunge. It's a two-tier market everywhere you look. But we really need to get to the climax of this data story. Foreign investors bought 1.27 trillion won in the cash equity market. Sounds huge, right? But wait. They bought 1.30 trillion won in just Samsung Electronics and Samsung Electromechanics combined. Let that sink in for a second. The total foreign index buying was entirely swallowed and actually exceeded by just two specific names. And here is the hidden signal. While they were busy vacuuming up AI hardware stocks, foreign investors simultaneously sold over 560 billion won in KOSPI 200 futures. Think about what that actually means. They're aggressively securing AI supply chain exposure while actively betting against the broader index. It's a perfectly executed institutional hedge. This leaves the rest of the market completely exposed. Rising yields forced domestic institutions to reduce broad equity exposure. Program trading unleashed over 1 trillion won of automated basket selling. Because local rules require these orders to hit multiple stocks at once, massive downward pressure was just forced onto the rest of the market. So, we're left with a stark realization. Are we witnessing a true market breakout or a heavily concentrated illusion where AI hardware thrives while the rest of the market suffers? The math just doesn't lie. Thanks for joining this explainer. If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.